Hi everyone, I'm Ava, and welcome back to Your Financial Journey. For a long time, interest rates weren't at the forefront of anyone's minds unless they worked in finance or were taking out a loan. Only in recent years have they been getting a lot of wider public attention, thanks to the fact that they're higher now than they've been at any point since the Great Financial Crisis more than 15 years ago. But the history of interest rates in America is a fascinating one, because it's not just the fluctuations that we're seeing now. In fact, interest rates have undergone massive fluctuations throughout time. That's impacted not just the course of our economy, but our entire country. So today, we'll be taking a look at the history of interest rates in America and what inflation was like at the time. We'll go through the different periods of American history, where interest rates were at and why, and what inflation was like at the time. Let's get started. America's founding, late 1700s to early 1800s. There would be no history of American interest rates if America hadn't won the Revolutionary War. But an American victory wasn't exactly certain from the beginning, not just because of the actual fighting on the battlefield, but also because the Continental Congress first struggled to pay for the rebel army at all. At first, it didn't even have the power to tax, so it had to borrow heavily from France, Spain, and the Netherlands, at rates of around 5%. Those foreign funds weren't enough, though, so the Continental Congress turned to borrowing domestically and printing money too. Bonds were sold with coupons of around 6%, but repayment was far from certain. And the Congress issued so much paper currency, the Continental dollar, that it lost all value. Thankfully, though, these efforts weren't for nothing, because the colonies won their independence when the Treaty of Paris was signed in 1783. But gaining independence didn't magically solve all issues. The new government was heavily in debt, the country's future was uncertain, and inflation had surged because of all the money Congress had printed. And as a result, borrowing money became pretty expensive. Only in the 1790s did things stabilize, largely thanks to the adoption of the Constitution and the efforts of Alexander Hamilton, who, as the country's first Treasury Secretary, pushed for reforms and a strong national credit system. The economy was tied to gold and silver, so the money supply was limited and interest rates stayed volatile. But U.S. creditworthiness was established. Early 18th century. During the first few administrations, the Jefferson and Madison presidencies, interest rates for government borrowing were moderate. But soon, a few events challenged that relative stability again, the first of which was the Louisiana Purchase in 1803. The government couldn't pay the total cost of $15 million, so it had to borrow money at an interest rate of 6%. But not long after, the War of 1812 created even more problems. People worried about the consequences of the war with Britain and seriously doubted whether their loans would be repaid, so the interest rates on government debt rose to over 7%. Thankfully, the U.S. did make it through the War of 1812 with minimal lasting damage, meaning that afterwards, it could begin to pay down its loans. In fact, in 1835, under President Andrew Jackson, the U.S. paid off its national debt entirely, the first and only time in history that would happen. For the next few decades, while there was limited federal borrowing, interest rates for state governments and private borrowers were generally around 4 to 6%. Those loans helped fund things like canals, railroads, and infrastructure, driving America's growth and expansion westward. There were times, though, when banking crises broke out in the United States, such as the Panic of 1819, the Panic of 1837, and the Panic of 1857. During these times, interest rates often spiked dramatically, even into the double digits. Still, though these panics led to fluctuations, for much of the early 18th century, things seemed to be going well. Civil War and Reconstruction, mid to late 1800s. In 1860, it seemed that history was repeating itself, because with the outbreak of the Civil War, the Union government found itself in need of money to fight the seceding Confederate States. Once again, it turned to borrowing and printing money. Bonds with coupons of 5 to 7% were sold, while the government issued so many greenbacks, or paper money not backed by gold, that their value quickly deteriorated. And all the wartime spending and printing led to prices increasing too. Over the course of the war, inflation reached over 80%. Yet bad as that was, it was still much better than the South. There, the Confederate government's rampant printing of money, as well as uncertain military prospects and shortages caused by the Union blockade, meant that inflation was over 9,000% by the end of the war. It was only once the war had ended, during Reconstruction, that things got better again. The U.S. returned to the gold standard, meaning that any money it issued was backed by and could be traded in for gold. As a result, the money supply was limited to however much gold the government actually had, which tightened the money supply and thereby limited inflation. The downside of that was that a lot of the late 1800s, generally a period of fast industrial growth, saw deflation, which hurt farmers in particular. And beyond that, political movements like the Free Silver campaign, which hoped to add silver to the money supply to reduce deflation, as well as various banking crises, led to instability and massive interest rate volatility. By the turn of the 19th century, it was clear something was needed to smooth out these violent swings, namely a central bank. The Federal Reserve era, 1913 to 1940s. In 1913, the Federal Reserve, or Fed, was created with the power to control the money supply, supervise banks, and provide emergency loans, all with the goal of bringing stability to the country's financial system and economy. After its creation, the Fed first kept interest rates low in the 1920s, helping the economy boom as innovations like cars, radios, and skyscrapers first came onto the scene. But by the late 1920s, the Fed raised interest rates to slow speculation on Wall Street, an effort that wasn't enough to stop the stock market crash of 1929, which rattled the economy and put banks under strain. But instead of lending emergency funds to help banks survive, the Fed stood back and let thousands of banks collapse, destroying confidence and wiping out savings. And at first, rather than lowering interest rates, the Fed kept interest rates high. That was despite the lack of inflation, and a prolonged deflation followed that lasted throughout the 1930s. Wages and prices fell while debt stayed the same, so businesses went bankrupt while families couldn't make ends meet. It was only when the U.S. entered World War II that things really started to turn around. The government had to borrow to pay for the war, so the Fed kept interest rates down. Inflation rose, bringing the country out of its deflation, and people saved money during this time, which set the stage for a post-war boom. Post-war boom and stagflation, 1950s to 1970s. Even today, the 1950s in America are remembered for their prosperity. As a time when the soldiers returned home, the economy shifted from war back to peacetime, suburbs grew, highways were built, and consumer goods flooded homes. Inflation stayed steady at around 2%, and interest rates climbed only gradually. That meant mortgages were affordable, and middle-class families flourished. By the late 1960s, though, things had changed again. Another war, this time in Vietnam, drained government finances, while President Lyndon B. Johnson's Great Society programs expanded social spending and contributed to inflation. That meant inflation crept up to 4 to 6%, and interest rates followed. It wasn't quite a crisis yet, but cracks were forming. Those cracks burst open in the 1970s, when two oil shocks, in 1973 and 1979, caused oil prices to skyrocket. Because of how crucial oil was, and still is, for industry and transport, that resulted in high inflation throughout the entire economy. Real consumer spending declined, and at the same time, businesses had to lay off workers as they struggled with the higher prices. That meant unemployment rose up to 8%, while simultaneously, inflation hit double digits, what's known as stagflation. Savings accounts lost value to inflation, companies struggled, and everyday Americans had to pay higher and higher prices for groceries and gas, even while countless employees lost their jobs. Times were certainly hard, and for many, it seemed like major change was needed at the Fed. The Volcker era and the Great Moderation, 1980s to 2000s. That change came in 1979, when Paul Volcker was appointed as chair of the Federal Reserve with the task of getting inflation, which had risen to over 14%, under control. He believed that the only way to do so was to raise interest rates aggressively, no matter the costs. So the Fed raised interest rates first to 12% and eventually to over 19%. Those higher interest rates had an immediate impact on the economy. Businesses collapsed, farmers went bankrupt, and in 1982, unemployment reached 10%. But in the end, the Volcker shock was effective, because by 1983, inflation had been brought down to around 3%, and global confidence in the dollar started to be restored. After the Volcker shock had brought an end to stagflation, America entered a long period of rare stability. From the mid-1980s through the early 2000s, inflation stayed low between 2 and 3%, and interest rates, while fluctuating with the boom and bust cycle as always, never reached the extremes of the 1970s or early 1980s. The U.S. economy grew steadily, families could make long-term plans, and businesses could invest with confidence. This period was known as the Great Moderation, because even major events like the dot-com bubble bursting didn't create runaway inflation. It meant security for a long time, but it also meant people became used to a world where inflation didn't seem like much of a worry anymore. The Great Recession, 2008 to 2015. The Great Moderation ended in 2008, when the housing bubble burst. That triggered the Great Financial Crisis, which later turned into the Great Recession, during which people lost homes, banks failed, and the economy almost collapsed. This time, the Fed stepped in to prevent a depression, slashing interest rates to nearly zero. Still, prices for homes, stocks, and goods fell, and unemployment once again reached around 10%. That meant additional steps had to be taken. The Fed introduced new lending programs and stepped in to manage specific bankruptcies or failures. These measures kept the economy afloat, and officially the recession ended in 2009. But the actual recovery was slow. For years afterward, growth was moderate while unemployment rates stayed higher than usual, and the Fed kept interest rates extremely low to try to promote spending and investing. By 2015, the economy was improving. The Fed began gradually raising interest rates, and they reached about 2.5% in 2018. Still low, but the highest they'd been since the Great Recession. And while the economy grew, inflation remained low. So despite some scares that rose in 2019 regarding global trade tensions, nothing major really happened in the economy until the COVID-19 pandemic. COVID and aftermath, 2020 to present. In 2020, the coronavirus spread through the world, resulting in shutdowns in countless countries, including the US. With people unable to go outside and many unable to work, the economy essentially froze overnight. Within weeks, unemployment reached nearly 15%, while GDP fell and the economy contracted. At first, that meant that inflation dipped, so the Fed once again cut interest rates to zero. But soon, as a result of trillions of dollars in stimulus spending, as well as the economy slowly reopening, that changed, and in 2022, inflation reached a peak of 9%, the highest rate in the past 40 years. But after some initial hesitation, the Fed finally reacted, raising rates from near zero to over 5%. While it wasn't quite a Volcker shock, it resulted in the highest interest rates the US had seen in nearly 30 years. Mortgages doubled in cost, while borrowing for businesses became more expensive. By 2024, inflation had cooled to around 3%. But even now, the direction that our economy is headed remains uncertain. At the time of this taping, the Fed has set interest rates between 3.50% and 3.75%, which some think is too high and stifling growth, but others think is too low and will lead to a resurgence in inflation once more. Only time will tell how things will work out this time. Because if the past 200 years have taught us anything, it's that the balance between interest rates and inflation is ever-changing and a tricky one to get right. What surprised you most about the history of interest rates in America? Or what other fun facts do you have to share on this topic? Drop a comment below to let us know. Make sure to like and subscribe if you enjoyed today's video. And if you want to learn more about how compound interest can make you rich, check out this video here to give your financial journey a boost. Thanks for watching, and we'll see you next time.